Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Monday everybody. I hope you had a good weekend and have a productive week ahead. 2 small pieces of housekeeping before we dive into the episode. 1, I am once again filming outside of my office in a nearby location because of noise in my office. This location has some background noise as well and some echo. I hope this is not too distracting for everybody. And 2, it is highly likely that tomorrow, Tuesday, there will not be an episode of China Update. So tomorrow, Tuesday, there likely will not be an episode of China Update. I will endeavor to release one, but looking at the schedule the way it is at the moment, it is highly likely I will not be able to get one out. But we should be back with regular episodes once again from Wednesday. Okay, let's begin. Over the last few days, there have been several developments related to the ongoing local fiscal and debt crisis, which we need to cover today. This is of course a general topic which we have been following for some time now. A topic which I argue is more consequential for the Chinese economy than the housing crisis. Let's move through these now. At a fiscal policy forum held late last week in Beijing, Dean of the School of Economics and Management at Beijing's prestigious Tsinghua University and renowned Chinese economist Bai Chong'en told the audience that local governments in China went 4 trillion yuan, $548 billion into the red as a direct cause of pandemic and zero COVID measures, and that the central government needs to issue special bonds to help them pay off debts owed to businesses. According to a Chinese financial media outlet Yicai report on Bai's comments, the economist explained that with the current discussion of resolving local debt risks, the focus is on whether a bailout will create a moral hazard and the expectation of a central government backstop. But he argues that pandemic costs as part of a black swan event should be viewed differently. To avoid moral hazard, he argues, it is necessary to distinguish between local debts that were caused by the pandemic and debts which reflect the expansion of local government spending for the local government's own interests. Bai added that to mitigate local fiscal difficulties and debt risks over the long term, the central government should reduce mandated policies that require local government to spend on certain projects, for example, growth or employment goals. Commentators discussing Bai's comments pointed out that much of this discussion surrounding local government debt is still focusing on the question of whether the central government should or should not bail out local governments, with neither side wanting to take too much of the bill. However, a growing chorus of voices argue that rather than look for new ways to finance it, China must instead sharply reduce the economy's over-reliance on non-productive investment to generate activity. That is to say, stop using debt to fuel growth. Regular viewers know this, of course. They know too that this is much easier said than done in the current economic and political environment in China. Meanwhile, we remember last week at an executive meeting, the State Council approved a campaign to push state-owned enterprises and provincial-level governments to pay the money they owe to businesses through arrears, saying that the direction, quote, must be regarded with great importance, end quote, as it, quote, concerns companies' production, operation, and expectations for investing, as well as the continued recovery of the economy, end quote. Chinese financial media outlet Caixin writes that overdue payments owed to private businesses, especially smaller ones, have been an issue for China for many years. This issue is also referred to as the triangular debt problem in some cases. Delayed payments by one company can leave its suppliers unable to pay their own suppliers and repay their loans. Quote, this chain hampers companies' ability to run their day-to-day operations, pay their staff, and invest. End quote. A report by Bank of China Limited in 2022 estimated that back payments owed to small and mid-sized businesses by large companies, local governments and other entities reached at least 6.7 trillion yuan, a little under $1 trillion in 2021 alone. Caixin writes, citing unnamed sources, that the most recent government efforts to settle overdue payments are part of policymakers' push to resolve local government hidden debt, which includes not only debt from local government financing vehicles, but also arrears owed to private businesses by local authorities, such as payments for mass COVID testing. Then, in a separate article also published over the weekend, the same outlet points out what regular viewers know all too well, that it's not only state-owned enterprises and local governments who are not paying their bills. Quote, property developers, many of whom are in the grip of a debt crisis, owe hundreds of billions of yuan to their suppliers. China Evergrande Group, for example, in July reported it had some 2.4 trillion yuan of total liabilities as of the end of December. That included 1 trillion yuan of trade and other payables, money owed to suppliers for products and services, of which 596 billion yuan alone was for construction materials. End quote. Beijing understands that all of this can be a great source of financial distress for the wider economy, but the fact that it has launched several of these campaigns to get on top of arrears suggests that it still is having great difficulty with this issue. And it's not surprising. After all, these local governments, state-owned enterprises and property developers are all facing debt crises and very tough liquidity constraints. Quote, one of the ways in which financial distress affects spread from highly indebted entities to other parts of the economy is through payment arrears. This has become a large enough problem in China that the State Council approved a campaign to deal with arrears. This may seem a reasonable proposal, but without specifying who is going to bear the cost, it isn't really a solution. Arrears are caused mainly by the fall in local government revenue. Until these are resolved, all local governments can do is shift the problem elsewhere. They can force the problem onto banks. If banks are forced to lend more to local governments, they can raise taxes or cut back spending, which will be bad for the local economy, or they can force suppliers to lend in the form of payment arrears. End quote. Next up, there is one more important and interesting part of all of this that we need to cover too. Hey everyone, if you enjoyed today's episode of China Update, don't forget to hit the like button. Liking, sharing, and subscribing are all huge ways that you can help keep China Update going and grow. And for anyone who wants to go the extra mile and help me keep this channel financially sustainable, Patreon and Buy Me a Coffee links are in the description below. As always, thank you so much, everybody, for the ongoing support. In an interesting development, it appears that China's credit investors are buying up bonds issued to its most indebted provinces, encouraged, analysts argue, by signs that Beijing will help local governments clean up borrowings. UK-based Financial Times writes over the weekend that local government financing vehicles have been rushing to meet renewed demand. Their monthly bond sales jumped in August to the second highest on record at 640 billion RMB, 88 billion US dollars, according to calculations by the Financial Times based on wind data. The surge in bond sales, the outlet writes, indicates onshore investors believe China will find ways to refinance and cut local government debt, as policymakers in Beijing work on a new model for local government financing vehicles to drive economic growth. Quote, the laxer monetary conditions and the stronger expectation of proactive debt resolution are behind the recent interest in local government financing vehicle debt. Government policy is always crucial for investing in China. It is now more important than ever. End quote. An unnamed Shanghai-based high-yield bond investor in a private equity firm told the Financial Times, quote, there's been a buying frenzy for local government financing vehicle bonds in recent months, and it has gone even crazier in September. Everyone now believes that this round of debt resolution of local governments will last for months, even years, and at least during this period of time, no local government financing vehicle bonds will default. End quote. Regular viewers will remember that although no local government financing vehicle bonds have ever defaulted on public markets, investors grew very cold in relation to the debt in the first half of this year, as several localities, most infamously Guizhou, appeared to be in a de facto state of bankruptcy and on the brink of default. This sentiment evidently has changed in the last 2 months. The market appears to believe that Beijing will help local government financing vehicles meet debt obligations. Indeed, the China Securities Regulatory Commission has vowed repeatedly over the last month to prevent any local government financing vehicle bond from defaulting. Now, I hope viewers will forgive two Michael Pettis quotes in one video. Quote, "Is Beijing helping extend local government financing vehicle debt? It probably has to prevent the risk of local government financing vehicle defaults spreading through the economy. But I hope it is just a temporary measure to give local governments time to deliver more permanent solutions to local government debt, one probably involving asset transfers. Almost every form of Chinese debt capacity has been pushed to the limit except central government and external debt. While there may be a temptation to use this remaining debt capacity to continue increasing economic activity, however wasteful, that would just postpone the inevitable and inevitably difficult adjustment and leave China with fewer tools to manage the consequent volatility and pro-cyclicality. It would be better that Beijing provides only temporary relief while forcing local governments to resolve the debt themselves. For now, that seems to be Beijing's plan. They have been extremely reluctant to bail out local governments and have repeatedly demanded they resolve their own balance sheet problems. There has even been the beginning of local government asset sales to manage just this. The problem is that under political pressure, temporary measures can become permanent measures. In that case, growth in economic activity might remain at 4 to 5% for a few more years, with real growth still below 2 to 3%, as Beijing exhausts the rest of its debt capacity." End quote. Now, on this theme, and next up, EU Trade Chief Dombrovskis, speaking in Shanghai over the weekend, expressed, quote, "China's economic model continues to focus heavily on investment and export-oriented investment, whereas the domestic demand side is lagging behind." End quote. This is, of course, a direct consequence of China's unbalanced growth model. The EU chief trade negotiator and executive vice president made the comments speaking at the Bund summit in Shanghai on Saturday. In his remarks, he expressed that the European Union has a very imbalanced trade relationship with China, and that while it is seeking to reduce its vulnerability when it comes to strategic products, quote, "that doesn't mean the EU is disengaging with China." End quote. The visit comes as the EU engages in a debate surrounding whether they should follow the US towards a more hawkish position on China, whether with trade or security policy. And hot off the heels of the European Commission announcing an anti-subsidy probe into Chinese electric vehicles, a move which Beijing called, quote, "a naked act of protectionism." End quote. Dombrovskis was in China for the so-called EU-China high-level economic and trade dialogue. US outlet Bloomberg writes that the forum will be used by senior officials from both sides to discuss issues related to macroeconomics, trade, supply chains, and financial services, and could also be a stepping stone for a summit between General Secretary Xi Jinping and EU's Ursula von der Leyen later this year. In an interview with UK-based The Financial Times yesterday, the EU trade chief warned over, quote, "new areas of concern with China," end quote, giving the examples of implications of the anti-espionage law and market access for foreign companies in the mainland, adding, quote, "we want to maintain a trading relationship with China. It's important, it's our second largest trading partner, but we need to address certain aspects of this relationship," end quote. Recent data show that the EU has now reached a €396 billion bilateral trade deficit with China, a record amount which the EU ambassador to China last week called, quote, "the highest deficit in the history of mankind," end quote. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Like I said, there may not be an episode tomorrow. Have a wonderful day, and I'll either see you tomorrow or on Wednesday.